much. We want to continue the conversation on the markets. For that, we want to bring in Adam Gold. He's Katam Hill founder and a chief investment officer. Adam, when you take a look at the market's recent action, we had the Dow off just around 100 points. If it closes lower today, it'll be fourth day in a row that we've seen declines for the Dow. From your perspective, what's weighing on investor sentiment over the last several days?
I think it's just markets catching their breath. And we've had a terrific year. Earnings in the second quarter were phenomenal. One of the largest beats relative to expectations in years. And we have very low interest rates. So that's something we'll talk about in a bit. But these are all very stimulative and conditions for companies, for consumers, for businesses. And so I think the markets are just taking their breath here, up almost 20% year to date.
Adam, the emphasis that we put on the correlation between the 10-year, for instance, the yield on the 10-year, and then the action we see in equities, are we in a new kind of, and I hate the expression, but a new kind of paradigm, where we should, as investors, stop using the old correlations and look at everything basically just from fundamentals? Have we overblown this discussion of taper and its impact on equities?
Well, it's important. I mean, historically, right, when rates were much higher, fixed income was a great alternative to riskier asset classes like equities. When you have rates where they are today, as well as inflation that's running at 5%, we think about, well, what's the alternative to fixed income being below inflation means you need to be investing into equities and to riskier assets. So looking forward, until fixed income can offer you higher returns than inflation, which we're not even close to that level today, then I think the fear and concerns over tapering and higher rates are a bit, they're not overblown because they're very important, given asset allocators will eventually think that perhaps if inflation gets lower and rates get higher, that there's a better alternative. We just focus on equities, and so we're quite biased in our view, but we believe equities are the only game in town. We've thought that for a very long time, and we still think that's going to be the case even after tapering and even after rates start to move higher.
So Adam, if equities are the only game in town, I guess what exactly are you favoring? What are you buying? Where are you seeing opportunity then over the next couple of months?
Well, we're very long-term investors, so I know we talked about where do we see the markets going on a daily, weekly, even quarterly basis. We don't think that's something that we spend a lot of time thinking about. Obviously, it's important to have a frame and a reference and understand where markets are, but we're fundamental investors. So we think technology is the greatest time to be involved when there's massive innovation, when there's exciting product cycles. And so we have very strict criteria what we invest in. We think about founder-led businesses with massive global markets that are profitable, that have innovation, that can vertically integrate, that have developers that work on their platforms, making their products better. So we think about the universe. And reality is there are very few companies that you want to own. And any given year, about a quarter of the market, looking at the S&P, a quarter of the stocks within it will decline. This is over the last 10 years. And of that 50% that are positive, half will underperform the benchmark. So only 1/3 of companies actually ever do better than a benchmark in a given year. So we just try to take that cream de la creme of the top and really realize and think that's where the best compounding can be for the next 10 years.
Adam, did you just make a case for passive investing, index fund investing? I mean, with the data you just shared with us?
Oh, no, quite the opposite. I mean, I think being in equities, I think I make the case, right? Equities have returned 11% the last 10 years. And overall, when the GDP expands, so another statistic, 91 years of history, we went back and looked at it, 85% of the time when GDP was positive for the year, which was about 3/4 of the time, 85% of the time the S&P was up in the year where GDP expanded. And when GDP declined, 2/3 of the time the market fell. So economic activity, which is job growth, production, expansion, these are drivers of stocks in the long term, not necessarily in any given week or month or quarter. But if you have a year where GDP is expanding, 85% of the time the market's going to have your back. So we're very positive on equities. We're particularly positive. We only invest really in amazing technology companies on a global basis. We still think that that's the place to be. And we just try to focus on those, very tight criteria with founder-led businesses that are profitable today, not, 10 years in the future.
All right, Adam Gold, Katam Hill founder and chief investment officer. Thanks so much for joining us.